Can you just kind of explain a little bit? Because I know a lot of people are self-employed now, of course, because of the pandemic.
Absolutely.
So can you explain what that is for them and what that looks like as far as them trying to get a mortgage loan?
Sure. So you always hear that it's quote unquote hard for self-employed people to purchase homes. Mm-hmm. That's not necessarily true, but when you hear that, there's one particular point of it that people are talking about.
Right.
And so when you're self-employed, obviously almost all self-employed people have things that they write off on their taxes. Mm-hmm. So let's just use, for example, if you have someone that's self-employed and their taxes show gross receipts of $200,000 a year. Mm-hmm. And when they finish their write-offs, they do their Schedule C. And their Schedule C shows that their business income is $15,000. From a mortgage qualification standpoint, that $15,000 for that year is their qualifying income.
Hey guys, it's No with Mo here with another episode. I am your host, Monique Williams, and I have with me today a special guest by the name of Matt Hedgepeth. He is a loan officer here in Florence, South Carolina. He's a father, a husband. Welcome to our show.
Thank you very much. It's a pleasure to be here. Thank you for having me.
Awesome. So Matt, can you kind of just tell us a little bit about what you do as far as being a mortgage loan officer? What does that look like?
So basically, I'm the person that facilitates the financing. I will get the buyer pre-approved, get the client pre-approved, gather everything we need for that for a mortgage transaction, and basically walk them through the process of buying a house from start to finish, from the point of having a contract written until we get to the closing table when they get their keys.
Okay. So how long have you been doing this?
I've been in the mortgage business in some capacity for about 19 years. I've been originating for 5 years now.
Wow. Okay. So Matt, tell me, in this market today, we know we're in the seller's market. Right. We know we've been dealing with COVID for the last 2 years, right?
Right.
Would you say it's a wise time to actually buy a house?
In my professional opinion, I do think it is. One of those main reasons being we're seeing historically low interest rates. Right. They have gone up a little bit this year from where they were end of last year, early part of this year, but still really, really low. Right. We're still seeing on certain programs and certain credit profiles rates in the 2s, rates in the low to mid 3s are really common. And if you bought a house prior to 2020, mm-hmm. you know that that's not so common.
Right.
So we're still in a good place, and also values are holding good. Mm-hmm. And I personally don't think they're going to go down. That's just my personal opinion. Okay. So I think it is a good time to buy and get into the house before they continue to go up.
Awesome. So I'm going to ask this question because I know I am a realtor, you're a mortgage officer. This is how we make our living. Right. So we've got to say these things. Right. But with that, would you, right now in this market, would you buy a house?
I would. My wife and I had actually looked at a couple of houses.
Okay.
Our family is expanding, and we have kind of toyed with the idea of moving again or moving from our original house that we purchased.
Okay. Awesome. So switching gears a little bit, okay. Would you say, or let me ask this question, as far as the consumer, what are the 3 top reasons that someone may not be able to get approved?
That's a great question. I would have to say, in my experience, credit score obviously is going to be a given. Self-employment is another big reason, and debt to income. And what a lot of people don't know is credit score is a major component, mm-hmm. obviously, of getting pre-approved for a mortgage, but debt to income is just as important or more important in some cases than the credit score actually is.
I'm glad you said that. That's good. And the reason I say that is because when I came into my job, of course, as a realtor, right. I came from nursing. Okay. And I came in as a realtor. I didn't really understand what debt to income meant. Right. So with that being said, can you just kind of expound a little bit on what debt to income means for the consumer?
Sure. So debt to income is exactly what it says. It's a ratio that compares your overall your housing debt and your overall debt
Okay.
versus what your actual income is. And I get the question a lot. People will say, how much do you have to make to buy, say, a $200,000 house? Mm-hmm. And my answer to that is always the same. It totally depends on debt to income. Mm-hmm. You could have a person that makes $30,000 a year be able to purchase a higher priced home than someone that makes $60,000 a year.
Wow.
Because that person that makes 30 may not have any other debt or very little debt. The person that makes 60 may have their income maxed out, so to speak.
Right. Okay, so that's good. The other thing that you said, of course, was self-employment.
Right.
Can you just kind of explain a little bit? Because I know a lot of people are self-employed now, of course, because of the pandemic.
Absolutely.
So can you explain what that is for them and what that looks like as far as them trying to get a mortgage loan?
Sure. So you always hear that it's quote unquote hard for self-employed people to purchase homes. Mm-hmm. That's not necessarily true, but when you hear that, there's one particular point of it that people are talking about.
Right.
And so when you're self-employed, obviously, almost all self-employed people have things that they write off on their taxes. Mm-hmm. So let's just use, for example, if you have someone that's self-employed and their taxes show gross receipts of $200,000 a year. Mm-hmm. And when they finish their write-offs, they do their Schedule C. Their Schedule C shows that their business income is $15,000. From a mortgage qualification standpoint, that $15,000 for that year is their qualifying income. Wow. And it's hard to get that thought process through to self-employed people, because they always say, well, I make the money, right, and I 100% agree with that. But like I said, from a lending guideline perspective, whatever you show as that final income amount is what you're actually able to count. So when you hear it's hard for people to purchase that are self-employed, not necessarily, but that's generally what people will be talking about.
Wow. I'm so glad that you gave that information, because I always get a lot of self-employed people, and like you said, they just don't understand. They make the money.
Right.
But on paper, they're not making any money.
Absolutely.
So that's good. That's good. So Matt, I know that a lot of consumers are able to get approved for FHA versus a, traditional conventional loan or something like that. Can you just kind of tell us the difference between a FHA loan versus that traditional loan, like a conventional?
Sure. So the reason that more people are probably able to get approved for FHA versus conventional, FHA has more lenient credit requirements than conventional does. Okay. Also, FHA has a more lenient debt to income ratio percentage, and kind of to flip that around to say that the opposite way, FHA allows a higher debt to income ratio percentage than conventional does. Okay. With FHA, you can cut off at what's called a back end debt to income ratio, which is your total debt to income, at 56.99. Conventional depends on the loan, but a hard cutoff is at 50.
Okay. Well, that's good to know. I'm glad you expounded on that. So real quick, this is just for our industry, and I know we're in the Florence market right now. Would you say that it's important who you actually get lending from?
I 100% believe that, and I tell clients all the time, if someone calls me and they say, I'm checking with such and such and it's an online lender, I will tell them just flat out, you don't have to use me. That would be great, right, but you don't have to use me. But if you don't use me, find a local lender. We have a ton of great local lenders in the area, in the PD region. I know most of them. I'm friends with a lot of them, and they're great people. They're great at what they do. I always say that you're going to get better customer service from someone that you may run into in the grocery store. Your kids may, play soccer together, or football or baseball or what have you, than someone that is just sitting at a desk in Michigan or Ohio, not to pick on, just far away,
right?
That doesn't care if they do your loan or my loan, because somebody else is going to call in 5 minutes and want a loan. Whereas if you're working with a local lender, our business, as you know from the real estate side, is 100% customer driven, 100% referral driven. So you're going to get better customer service, in my opinion, out of a local lender than you will a quote unquote online lender. Okay.
Well, that's good to know. So on Know with Mo, we do something called Then and Now. Okay. And this is on every show. I want to know, if you knew what you knew now, would you change one thing from the past?
Professional wise, yeah, I would have started this a long time ago.
Me too.
I was about 35 when I started actually lending.
Okay.
Like I said, I've been around the mortgage business my whole career, but seeing the benefits of it as far as from I'm a people person. I enjoy people. I enjoy talking to people and helping people, and seeing the benefits of doing this job and being able to help people get in homes, and especially when people think that they can't get in homes. Right. I've really enjoyed it. It's been, a blessing to my life, and I wish I had started it earlier on. I actually told my son, he told me recently, I asked him, I said, what do you think you want to do? He's 11. I said, what do you think you want to do, when you grow up? And he's like, well, I want to do what you do, Daddy. And I was like, well, that might be fine. Right. But if you do, you need to start it early. When I started it, I was a single dad, on my own. I went from a salary-based job, W-2 salary, to full commission, which was a big leap. Yeah. And thankfully, 5 years later, it worked out. But if I could have started that journey earlier on, I think that would have been great.
Okay. That's good. So, Matt, with what you've learned in the last 5 years, moving forward, what is one piece of advice that you would give the consumer trying to buy a house in this market right now?
Sure. Obviously, savings, that's a given. And the reason I say that is, I know you see it as much or more from the real estate side as I do. It used to almost be a given that sellers would pay their buyers' closing cost.
Right.
I always say, 9 out of 10 transactions, the seller's paying the buyer's closing cost. That's obviously not the case anymore in the market that we're in. And I don't know that we're going to see that trend change anytime soon. So savings more than ever now, if you're thinking about purchasing. Another tip that a lot of people may not know or may not even think about, I would tell potential buyers to get a credit card. And the reason I would tell them that is a credit card is can be one of the biggest positive things to a credit score, or it can be a biggest detriment. So if you don't have any revolving credit, that hurts your credit score. Right. If you have revolving credit and you run the balance up too high in relation to the limit, that also hurts your credit score. So the sweet spot, I guess, if you will, is to have credit cards, use them, keep the balance less than 30% of whatever the limit is. Don't pay them off. I tell people all the time, if you pay them off, it will hurt your score. I know that sounds crazy, and I don't know the algorithms behind the credit bureaus, but that's just how it works. Right. So that would be one small tip that I think would help anybody that doesn't have a credit card. Actually, if you don't have a credit card and you get one and you keep your balance very low, you will see an increase in your credit score, even if you already have good credit.
That's good. That's really good. That's a good tip, you guys. So make sure you take it. So Matt, thank you so much again for joining us here with Know with Mo. We appreciate you for coming.
It was my pleasure. Anytime. I loved it.
Thank you. You guys, thank you so much for joining another show of Know with Mo. As always, your host, Monique Williams. Make sure you go and follow us on social media and also subscribe to our YouTube page, Know with Mo. See you guys next time.